I'm going to level with you right now. $100 is not a lot of money. In fact, when I was in my early 20s, I would have been happy to make $100 a day. I know you're probably not looking to get rich off of $100. But here Sue should still consider investing it, and how you can make that initial investment go much further. The sooner you start, the better, because of something called the snowball effect, or as some people call it, compound interest. And no, this is not a scam, a pyramid scheme, or a Ponzi scheme. The idea is simple. Right. Say you invest $100 today, and that doubles to $200. Then that $200 compounds or increases at a rate of 10% per year. At the end of year 1, you'd have made $20, giving you a total of $220. Then in year 2, you'd earn 10% on the $200 original amount, plus the $20 you earned in year 1, meaning you'd make an additional $22, bringing your total to $242. By the end of year 3, you've now made $30 from compounding, and after 4 years, you've made $36. And this is with a low rate of return of only 10%. The more you earn on your investment, the faster the snowball effect occurs. Now imagine you invest $100 into a savings account that earns an interest rate of 1% per year. After 1 year, you'd have $101. That $1 earned through interest isn't much to write home about, but it's still a good start. However, with inflation around 3%, the real value of your $100 decreases to just $97.12. It's not a significant difference now, but if you invest regularly, say $100 a month for 5 years, the differences become more pronounced. Here's how. If you earn 10% annually, your $100 will grow to $110, then $121, then $133, and then $146, while the total invested increases to $600. On the other hand, if you earn only 1%, your $100 will grow to $101, $102, $103, and $104, with the total invested still being $600. Therefore, although the real gains may not be visible initially, starting early has a considerable impact over time. So where should you invest your $100? It all depends on your risk tolerance. There are various options available, and the best choice for you depends on your unique circumstances and preferences. Let's look at the pros and cons of each type of investment to help you decide. First, savings accounts. While they typically have higher rates compared to traditional savings accounts, they still fall short of beating inflation. According to the Federal Reserve, the average interest rate on a savings account is between 0.06% and 0.14%. The national inflation rate in the United States is currently 3%. This means that if you were to keep $100 in a savings account, its purchasing power could decrease by up to $2.86 every year due to inflation. Next, we have money market accounts. Money market accounts are designed for liquidity. If you're looking for a safe place to store your money with easy access, they can be a good choice. These accounts often have check writing privileges and can be FDIC insured. Currently, many money market funds offer interest rates ranging from 2% to 5%, making them more appealing than savings accounts. But it's essential to note that these funds aren't risk-free. Then, we have Treasury securities. As we all know, governments are notoriously bad at managing money. However, owning a piece of the federal government is considered to be extremely safe. In fact, it's even safer than owning a savings account at a local bank. The reason is that if the bank goes bankrupt, the FDIC will reimburse you up to $250,000. But there's no such thing protecting your money at a commercial bank. There are several types of treasuries you can invest in. First, there are Treasury bills, or T-bills, which are short-term debt obligations with maturities ranging from a few days to 52 weeks. Next, there are Treasury notes, or T-notes, which have maturities of 2, 3, 5, 7, 10, and 30 years. Finally, there are Treasury bonds, or T-bonds, which have maturities similar to Treasury notes, but they can also be bought at a discount. The current yields on Treasuries range from 3.31% to 4.88%. Although they beat the national inflation rate, they're still lower than the return on most investments. Next, we have corporate bonds. Bonds issued by corporations generally offer higher yields than government bonds, but they also carry more risk. Before investing in corporate bonds, it's crucial to evaluate the issuer's creditworthiness. If the company defaults on its debt, you might lose some or all of your investment. Let's talk about stocks. When it comes to stocks, there are a few different ways to invest. The first is to buy fractional shares of large companies. Large companies like Apple and Microsoft are generally considered less risky than smaller ones. They tend to be financially stable and have a history of paying dividends. The second is to buy full shares of smaller companies. Smaller companies have the potential for higher growth, but they're also riskier. These companies may face challenges staying profitable or competing in their industries. And finally, we have exchange-traded funds, or ETFs. ETFs allow you to invest in a wide range of stocks with a single purchase. They can provide diversification and professional management at a relatively low cost. Some popular ETFs include SPY, VTI, and VXUS. Each ETF tracks a different index. SPY tracks the S&P 500, which includes 500 of the largest publicly traded companies in the United States. VTI includes 3,634 U.S. stocks that represent a broad cross-section of the U.S. stock market. VXUS includes international developed markets. The current price of each ETF is listed below. The great thing about all three ETFs is that they have an expense ratio of 0.03%. This means that for every $10,000 you invest, you'll pay $3 in annual fees. Another advantage of ETFs is that they are highly liquid. This means you can buy or sell shares of the ETF on the open market at any time during the trading day. You can trade these ETFs at any brokerage that offers commission-free trading. So what's the bottom line? Which investment type should you choose? Well, it really depends on your situation and goals. If you have a low risk tolerance and are saving for a short-term goal, then go with a savings account. If you have a medium risk tolerance and are saving for a mid-term goal, then try a money market account or a treasury account. And if you have a high risk tolerance and are saving for a long-term goal, then consider investing in stocks. It's worth noting that if you're going to invest in stocks, you're better off putting all $100 into a single stock rather than spreading it across multiple stocks. This is because each stock will experience its own volatility, and by concentrating your investment in one stock, you'll be able to ride out any short-term fluctuations more easily. Finally, if you're still unsure, there's nothing wrong with opening a Roth IRA and putting $100 a month into an S&P 500 ETF. Just make sure to max out your contributions every year until you reach the annual limit of $6,500. This way you will take advantage of the tax benefits of a Roth IRA while also getting exposure to the entire stock market. Plus, you'll be able to withdraw your contributions penalty-free and tax-free at any time. And that's it for now. Thank you so much for watching. And remember, investing in yourself is the best investment you can make. So keep learning and growing.